Again, this question has been tested after a long span of time. Evaluate whether the company is doing over trading or not. 6 marks. Sorry, 12 marks. 6 marks are for calculation. So what are the remaining 6 marks for? Evaluation, discussion. So this is the data given to you regarding the company. The following financial information relate to Grow company. It is available. All sales are made on credit on the company operates on. Before I proceed to discuss it, I just want to recall what over trading actually is. I want to recall that. Okay, so that we can easily spot. We know if we know the symptoms of a disease. Okay, so we can easily spot what is the issue. So over trading. Over trading. So trading beyond capacity. Trading beyond capacity. Since what is capacity? The money you have in your pocket, you are going to support and trade at a level which is not being supported by the money in your pocket. You are going to play bigger than your capacity. It means you will have less working capital and sales increasing disproportionately. So what will the impact? So sale will be growing, inventory will be growing, but receivables will be growing and days as well. Their days will be growing. But how they will be financed? The problem is they should have been financed ideally. From where? You should have invested, you should have injected, you should have injected long-term fund to support it. Some debt, long-term debt, some long-term equity. You should have used that to support it. But you have not done that. So how this growth in sales and inventory is being financed? What is being stretched beyond capacity? That is current liabilities. That is called current liabilities. Now, what are in current liabilities primarily? What they are? That is two things. Payables, which are suppliers. You are paying suppliers later than you promised. The second is overdraft, which is crossing its limit. So payables growing, payable days growing. So you are financing your growth in the business through it. So symptoms are clear. Inventory days increasing, receivable days increasing, but payable days increasing. Overdraft increasing rapidly. And very, very important, two ratios, quick ratio and current ratio, they will be falling because current asset divided by current liabilities. Liabilities are growing rapidly. They're falling. And the last, which we can say conclusive evidence, I normally say. One is this conclusive evidence, overdraft and payable. That is called working capital turnover ratio. What is that? Sales to working capital. Sales over working capital. What is working capital? We know that that is current assets minus current liabilities. This ratio, working capital turnover ratio, this is increasing, rapid increase. What this ratio tells actually? First of all, we need to understand what this ratio is about. Working capital turnover ratio is about that how efficiently and effectively working capital is being utilized to support sales. For example, industry average is 10 times. For example, the company which we are analyzing, that is having 12 or 14 or 13 more than industry average. It means it is over trading. Now, so we have understood the symptoms of overtrading. What is the solution for overtrading then? Solution for the company. Before I go to the question, the first of all, stop growth. Maintain the operation, do not grow. But if you want to grow, inject capital, equity or long-term loans. There is no third solution available for it. You need long-term funds. Now, here we are. So we will be doing analysis. If we see sales is increasing rapidly, you can see 900 to 1530. Huge increase in sales. Inventory days we will calculate, amounts are in, cash is zero. This is another symptom that cash balance is falling. You don't have cash because everything is invested in the inventory and receivables. And you see here this indication 63 to 143 payables, overdraft from 0 to 11. So all and a few ratios we need to calculate, quick ratio, current ratio for both years, and then working capital turnover ratios. Come here. I have done this calculation for you people. Now, so grow company. Here is the calculation. So inventory days. What is the formula for inventory days? Inventory divided by cost of sales. For both here, I have calculated. It is same. Receivable days increasing. How to calculate? Receivables divided by sales into 365. It is increasing. Payable days. Payables divided by, should I write formulas? Tell me, should I write the formulas? Or is that works? Tell me. Yes. So then it's a cash operating cycle. We know that cash operating cycle inventory days plus receivable days minus payable days. So cash operating cycle has increased. Now cash is tied up for 50 days. Current ratio is current assets divided by current liabilities. I have simply taken these figures from financial statements. I have not added anything from my side. Yes, you just see here. 214 current asset 214 2x 20x6 current liabilities. Simple. Quick ratio. So 214 minus inventory quick ratio divided by current liabilities. And same, you see, both are falling. Overtrading symptoms. Increase in sale is 70%. Now sales to net working capital. Sales 20x6. 900 divided by current assets. All current assets minus current liability. Same here. The next year as well. Sales 1530 divided by 107252 minus 143 minus 11 overdraft. So working capital turnover ratio increasing. Now, if you have done this calculation, your 6 marks are secured. Okay. Now discussion. Starting with the definition. So ratio analysis is given in the appendix. So Grow company has expanded rapidly with the 70% increase. Now analysis, sales. Such expansion will require investment in working capital. The cash operating cycle was 43 to 50. Okay, so then is the little long-term capital has been added. No ordinary shares, no further long-term debt has been taken out. Right? So cash balance have went from this to an overdraft of 11. The current ratio has fallen, quick ratio from this to this. But they have fallen dramatically. Now, very important line. Since industry average is not given to us, this line is very important. Very important. It is not known whether this is below or above industry average. We do not know. Next. The next point is receivable days have increased. Longer credit time has been used to promote sale. Payable days have increased by slowing down payment to suppliers. This is very important to discuss in detail because we are building case. This is another sign of overtrading. Turnover have increased from this to this. Means same level of working capital is being used to support increased level of operation. A clear sign of conclusion. Right, conclusion. Valuation means where they say evaluate, always write conclusion lines at the end. The company is showing signs of their ratios are safe but still solvent. However, if they continue to expand without it, additional funds, it is likely to fail. Any confusion, any problem? Now, so overtrading is done. Now come back to the next question. So 12 marks. So actually, if I say for 6 marks, you need to make some 6 points at least, valid points, 1 mark per point. Like this. I can share its answer with you, which I have actually done. Don't you worry, okay? Now, explain the advantages and disadvantages of a conservative approach as compared to aggressive approach to financing grow companies' working capital requirements. 8 marks. Now, reading and understanding the question is very important. Take a pause. The question is about financing. Key points. What are the key points? Advantage and disadvantage. Two things. Conservative and aggressive. Two approaches. Advantage and disadvantage of the both for this company's requirement. So means that if I draw it to make our life easy, this analysis is very much important. I'm telling you that conservative and aggressive approach for financing working capital, its advantages and disadvantages. Advantages and disadvantages. Now it will become easy for you to write for 8 marks. It means 4 marks for it, 4 marks for it. 2 marks for it, 2 marks. And you have to link to the grow company. Your answer will be generic, but some tailored to the scenario. So life will become easy for you. Now come here. What is conservative approach? First of all, definitions of the both. So conservative approach of funding. Conservative means less risk. So majority of the current assets, they are financed. Majority means, if you call the graph, if you have studied, this is the timeline. These are the current assets. For example, this is the graph. This is permanent current assets because current assets are not falling below it. And this is fluctuating current assets. What is aggressive approach? Conservative approach. Conservative approach. Just see here. All this plus majority of it. We want less risk. Conservative. So they will be financed through long-term funds. And what is the aggressive approach? Inverse of it. High risk. All this and majority of it will be financed through short-term funds. High risk. So now the definitions are given. So now advantages of conservative. More security to borrower. because you are going to take long-term loan. You are not going to rely overdraft. You are not going to rely overdraft. Overdraft has to be renewed again and again. And there is sword hanging above your head. But anytime bank say, sorry, we will not renew. It will not happen here. There is no risk. So long-term funds is secure. Yes, but there will be covenants attached, conditions attached with that. Okay, now, so these lines are for conservative approach. These lines are for aggressive approach. Advantage of conservative approach are drawbacks of aggressive and vice versa. So disadvantage of conservative approach compared to aggressive, it is expensive. Long-term loans are higher interest rate because funds are tied up for long. For the lender, there is a high risk because the lender is giving you money for the longer time. So is on more uncertainty. They say we are giving you a loan for 5 years, give our high interest. Now, second, equity. Equity finance is expensive. Short-term source of finance, trade payables are free. Overdraft can be very, so just see comparison is being done. Overdraft will be only paid when you take out money. Otherwise, you have not to pay. But the long-term loan, once it is funded, you have to pay. And there is no rocket science. You have to make total 2 points here and 2 points here. 4 marks. Sorry, two, not two, rather 3 to 4. Yes. Discussion. 2 parts about each. It is done. Not difficult at all. Now, so students, this question is also done. Now, my task for discussing this is done. Anything you want me to discuss from your side, tell me. Anyone, any question, please? Yes, I am sending you. Don't you worry. Let me send you here in the chat box. There is a question from a student. What is the difference between funding and financing? No difference there. No difference at all. Funding and financing. Investment is, there is investment. Yes, working capital investment is something else. There is another question in exam which is tested, that working capital investment So working capital investment is something else. That how much you should invest. Small amount, higher amount, aggressive, moderate. That is very easy concept as compared to this. This was more tricky. Okay, so let me explain it if you want the explanation of that. So what is the working capital investment? Okay, I will explain, don't you worry. Okay, so working capital investment. What happened? Yes. Working capital investment. It talks about how much amount to be invested in working capital. And you know, the concept of over trading and over capitalization is directly linked with it. If you invest more than required, less than required, if you invest less than required, it results over trading. If you invest more than required, so there is two approaches, investment approaches, three, sorry. One is called aggressive approach again. The other is called moderate or matching. The third is called conservative. Now, so aggressive approach means that you are investing less, and it may result in over trading, less than required. Conservative means that you are investing more than, means you are playing very safe, and it may result in overcapitalization. And moderate is in between, playing in between, moderate. Is that clear? Is that clear? Any other question, please? Anyone, any other question? Welcome. Someone asked me in the WhatsApp, on my WhatsApp, that I need to explain cost of debt a bit, a quick revision of cost of debt, right? And some past exam question as well. Okay, right. Why it is not writing? Just a minute, please. Cost of debt. How to calculate? Debt is of two types. One is called tradable, non-tradable debt. Non-tradable debt, that debt which is the bank loan, for example, overdraft, which is not trading in the market. Simple. Cost of debt is equal to interest rate, whatever the interest rate is, into 1 minus tax rate. Simple is that. Non-tradable, 1 minus tax rate, tax saving. Tradable debt, debt which is trading on the market, stock market. They are of three types. One is called irredeemable bonds, debentures, loan notes. Company has issued that bond that is trading in the market. Company will not refund its amount. It behaves like share. So its cost of debt is calculated using dividend valuation model. Same way. In the dividend valuation model, how we calculate dividend over market value of share? We do that. That is called cost of equity. Cost and dividend over market value. So cost of debt, here interest is paid. Interest amount, annual interest amount into 1 minus tax rate divided by market value of debt. Second is redeemable debt and convertible debt. Third one is convertible bonds or debt or loan notes. They have to be repaid principal amount after a certain period of time, and they are the right of conversion into certain number of shares. Their cost is calculated through IRR of cash flows. Both. So redeemable debt, we draw their cash. For example, 5-year bond. So 0, 1, 2, 3, 4, 5. Initially, we put market value of bond. Then we put interest, annual interest. And here we put redemption value. We calculate net cash flows of the bond. This is negative. Market value is always negative. Investment. Then we calculate IRR of the cash flows. This IRR is called yield till maturity of bond. Bonds return, it is called cost of debt. We need to calculate cost of debt. IRR into 1 minus tax rate. Post-tax. There is another method that you do post-tax interest here. In that case, when you do, and then you calculate IRR, in that case, IRR is equal to cost of debt directly. If you do post-tax interest over here. Now, for the convertible bond, in the final year, here, we put conversion value. For example, we put higher of conversion value and redemption value. Now, let us discuss it. That, for example, a bond redeemable at $105. This is redemption value. Or convertible into 30 shares of company in 4 years. In 4 years. Market value price per share now, that is $3.4 and expected to grow at 3% per annum. What is the conversion value? So one share price now growing at the rate of 3%, 0.03 for 4 years. This will be price of per share in 4 years time. And they will be getting how many shares? 30. Now multiply all these. That will be conversion value of bond. Need not to memorize any formula. If you know how to calculate, need not to calculate that. Anyone, any question, please? So I have almost done with my today's task. Tomorrow, what I am thinking, there is a mock, FM mock for published by ACCA for December exam. I want to discuss that. Okay. Plus, I will be discussing examiner report. Anything else you want me to discuss? This is my contact number. Your suggestions are welcome via WhatsApp. Okay.